This could be one of the most beneficial trading videos for all traders. An 8-figure verified trader revealed his complete system for going from a total beginner to consistently profitable, and it's nothing like what most people think. Umar Ashraf, founder of TradeZella, has cracked the code on something that 90% of traders never figure out. But here's the thing. It's not about finding the perfect strategy or having some magical aha moment. Because the biggest lie in trading is that there's a moment when everything suddenly clicks and becomes easy. The truth? Even after 12 years and 8-figure profits, Umar still follows the exact same process he has shared publicly. The moment when he could rest easy never arrived. Most traders approach this completely backwards. They jump straight into complex strategies and chase profits from day one, and wonder why they keep blowing accounts. Meanwhile, the professionals follow a completely different playbook. Therefore, today we dive deep into one such playbook developed by Umar. We're breaking down his 5-stage framework that transforms novices into expert traders. Though Umar is a day trader, most of his findings and the process apply to all forms of trading. By the end of this video, you'll understand why most traders fail, what separates the professionals from the amateurs, and most importantly, the step-by-step roadmap to consistent profitability. If you're new to the channel, don't forget to subscribe and check out our library of videos on trading and investing. We break down complex trading concepts from legendary traders, explaining their strategies in a clear, no-nonsense way. If you'd like to dive deeper into my personal trading strategy developed over 30 years and offering stellar returns, consider joining our group. You'll get access to my complete strategy PDF and a custom-built scanner that helps me find winning stocks in a fraction of the time compared to conventional methods. Before we dive into the 5 stages, Umar revealed 5 critical truths that every trader must accept. These aren't just mindset tips, they're the foundation that determines whether you'll join the 10% who succeed or the 90% who fail. The first truth is that trading is not easy. Most people enter trading expecting quick riches. When reality hits and they face their first losing streak, they're mentally unprepared. But when you accept upfront that this is one of the hardest professions in the world, you develop the resilience needed for long-term success. The second truth: money is not your goal. This is counterintuitive, but Umar emphasizes this repeatedly. The moment you start tracking progress by dollars, you've lost. Instead, your goals should be process-focused. This month, I want to identify good versus bad setups. This quarter, I want to master my emotional triggers. Why? Because money is simply a byproduct of mastering the process. Chase the process, and profits will chase you. The third truth: control only what you can control. You cannot control market direction, news events, or whether your trade wins or loses. But you can control your risk per trade, your trade selection, your emotional state, and your daily routine. Professional traders obsess over these controllable factors, while amateurs waste energy predicting unpredictable market movements. The fourth truth: there is no aha moment. Even after 12 years, Umar doesn't have some magical moment where trading became easy. This is crucial because most traders spend years chasing this mythical breakthrough instead of focusing on consistent daily improvement. The fifth truth: psychology is overrated, early on. This might shock you, but Umar believes emotions are blamed too often for early-stage failures. The real culprits? Lack of edge, poor risk management, and oversized positions. If you're risking $50 per trade and losing $50 doesn't emotionally affect you, then emotions shouldn't hijack your process. Save the psychology work for later stages when you're trading meaningful size. Now let's break down Umar's complete 5-stage system. Think of this as building a skyscraper. You cannot skip the foundation and jump to the penthouse. Stage 1. Building your foundation. In this stage, novices with 2 to 4 weeks in trading must focus on foundation building and market familiarity. You must risk under 1% per trade with a goal to develop basic process and rules. It's here where most traders either set themselves up for success or doom themselves to years of struggle. Here are some basic areas you must address in this stage. Market selection. Pick one market and master it. Umar trades ES and NQ futures during New York sessions. Don't spread yourself across crypto, forex, and stocks. Depth beats breadth every time. Trading style. Decide if you want to scalp, day trade, or swing trade. You can experiment here, but commit to testing one approach thoroughly before switching. Capital requirements. Start with $1,000 to $3,000 maximum. Risk 0.5 to 1% per trade. If you have $2,000, you're risking $10 to $20 per trade maximum. This isn't about making money. It's about surviving long enough to develop skills. Here is the non-negotiable process in Stage 1 from a day trading perspective. You can adapt them for swing trading, taking into account the longer holding period. Every single day, you must complete 3 steps. Number 1. Pre-market game plan. Before markets open, analyze economic events, identify key levels, and plan potential trades. Number 2. Live trading notes. During trading, document your thought process every 15 minutes. And thirdly, post-market analysis. Review what worked, what didn't, and what you learned. This process continues through all 5 stages. Even 8-figure traders follow this routine religiously. Stage 2 is developing your playbook. This is where you transition from random trading to a systematic approach. This is typically the longer stage, lasting 2 to 3 months of intensive development. Here are some basic areas you must address in this stage. Strategy selection. Whichever strategy you choose, you must understand the underlying concepts. For example, Umar uses order flow, essentially reading the auction between buyers and sellers to identify strengths and weaknesses. I follow lateral breakout in quality stocks. Mark Minervini follows the VCP, and so on. But here's the key. Don't just copy someone's setup. Understand why it works. What market conditions favor this strategy, and what's the logical foundation? In this phase, you must develop playbooks for specific setups. Let's use Umar's morning top setup as an example. Here are his setup rules. Market gaps down from previous close. Time window, first 5 minutes to 1 hour after open. Entry criteria, upside move with no follow-through. Confirmation, selling pressure or activity slowdown. Direction, short trade expecting downside. Then ask the critical questions pertaining the setup. Why does this setup work? Market gaps down showing initial weakness. Attempts to recover fail, confirming the downward bias. What invalidates it? Strong volume on the upside move or breaking key resistance. And what market conditions favor it? Risk-off sentiment and no major news pending. Then comes the backtesting process. Go back 2 to 3 years and identify every instance of your setup. Document win rate, average risk-to-reward ratio, best and worst performing conditions, and common failure patterns. This isn't optional. It's how you build confidence in your edge. Next, data tracking in R multiples. Stop thinking in dollars. Every trade should be measured in R. Risk $100, make $200 is plus 2R. Risk $100, lose $100 equals minus 1R. Risk $100, lose $150 equals minus 1.5R. This is a problem. You're not following your stop. Track everything. R multiple per trade, stop loss effectiveness, entry timing, exit timing, and emotional state. In Stage 3, the focus is on optimization and problem solving. By this stage, you should have enough data to identify your recurring problems. This stage is about systematic problem solving. Here are some common issues Umar identifies. Poor R multiples, not letting winners run. Ineffective stop losses, too tight or not followed. Bad trade selection, taking low probability setups. Timing issues, entering too early or late. And rule violations, exceeding risk limits or trade counts. Once the problems are identified, then is the time to solve them using the problem-solving framework. First, understand. Dig deep into why one problem occurs. Second, solution. Create specific rules to address it. And third, track. Monitor improvement over time. For example, if you're cutting winners short, identify. Average winning trade is only +1 R despite +3 R potential. Understand. Fear of giving back profits causes early exits. Solution. Set minimum hold time or use trailing stops. Track. Monitor if average winner improves to +2 R or better. This stage also teaches you to adapt to changing conditions. For example, Trump's election changed market dynamics, and Umar had to adapt to them. Professional traders adjust their playbooks when market character shifts. You're not trying to predict these changes, you're building the flexibility to recognize and adapt to them. Stage 4 is advanced risk management lasting 6 months to 2 years. This is where emotions finally become a major factor because you're now trading meaningful size. This is also where most traders get stuck. Umar's risk management philosophy remains constant. Capital preservation is everything. Without capital, you cannot trade. Every decision should prioritize survival over profits. This means, in this stage, you can finally start increasing risk through position sizes, but systematically. Increase position size by 20 to 30% maximum, only on your highest conviction setups, maximum 1 to 2 increased size trades per month, and never increase size during drawdowns. Next, Umar identified several critical triggers for emotional trigger management. After big wins, overconfidence leads to oversized next trade. After big losses, revenge trading to get even. During hot streaks, taking unnecessary risks, and during cold streaks, abandoning the proven process. He then delves into advanced risk management rules for Stage 4. After a large winner, size down on the next trade. During drawdowns, reduce position size by 50%. Take mandatory breaks after 3 consecutive losses, and take breaks during extended winning streaks. Umar advises to use the staircase approach for position sizing. Think of sizing up like climbing stairs, not taking an elevator. If you normally risk $1,000, don't jump to $10,000. Go to $1,200, then $1,500, and then $2,000. Each step should feel manageable. Finally, Stage 4 traders know when not to trade. During high volatility periods, major news events, or when market character is shifting, reduce size or step aside entirely. Stage 5 is professional execution. This stage isn't a destination, it's a continuous cycle between stages 4 and 5 as you scale and adapt. Here are the characteristics of Stage 5 traders. Consistent process regardless of market conditions. Ability to adapt playbooks to new environments. Emotional control under significant pressure. Understanding of when to be aggressive versus when to be conservative. And a systematic approach to scaling position size. Even at Stage 5, Umar emphasizes that there is no arrival. Markets evolve, and successful traders evolve with them. The process that got you to Stage 5 is the same process that keeps you there. From time expectations perspective, Umar's journey took 8 years, but he believes this framework can cut that to 3 to 5 years for dedicated traders. The key is not rushing through stages and building proper foundations. Umar Ashraf's framework reveals why most traders fail. They skip the foundation and jump straight to advanced concepts. But success in trading, like building a skyscraper, requires a systematic approach. To make the most of Umar's playbook, honestly assess which stage you're currently in. If you can't consistently follow basic rules or haven't developed proven playbooks, you're not ready for advanced stages. There's no shame in going back to stage 1. Even experienced traders return to basics when markets change. Remember, this isn't a sprint, it's a marathon. The traders who succeed are those who build unshakable foundations and systematically develop their skills over years, not months. The path to 8-figure trading success isn't about finding secret strategies or having natural talent. It's about following a proven process with discipline, patience, and unwavering commitment to continuous improvement. Start with stage 1, master the fundamentals, and trust the process. Your future profitable self will thank you for building the right foundation today. As always, thanks for watching.